In today's video, we are breaking down a powerful idea that's starting to gain serious attention in the crypto space. A suggestion from Ripple CEO Brad Garlinghouse here, highlighted by crypto analyst John Squire, points toward a long-term valuation model that places XRP near the $100 price level. Now, this isn't a hype-driven prediction or a short-term moon call. Instead, it's a structural argument rooted in institutional adoption, digital asset infrastructure, and real-world utility. What makes this discussion important is that it shifts the XRP conversations away from speculation and towards scale, integration, and financial relevance. So, let's unpack what this actually means for the market and why this scenario may be closer than many expect. So, what did Ripple CEOs actually suggest about XRP's long term value? Brad Garlinghouse remarks, as highlighted here by John Squire, were not framed as a direct price forecast. Instead, they focused on market capitalization potential. The idea is simple but powerful. If XRP were to reach $1 trillion market cap, its unit price would land close to $100, assuming the current supply, assuming the current supply structure. This perspective reframes the discussion entirely. Rather than asking when will XRP pump, the real question becomes what role could XRP play in $1 trillion financial ecosystem? Market impact here lies in expectation management. Long-term investors may begin valuing XRP based on function and scale, not short-term volatility. This approach aligns XRP with how traditional assets are valued by relevance, demand, and systemic importance. So, why is institutional digital asset infrastructure so critical to this scenario? The foundation of this valuation thesis is institutional adoption. According to Squire, Garlinghouse sees XRP as part of a broader transformation in how value moves across the global financial system. Institutions are not entering crypto for speculation. They are entering for efficiency, compliance, and scalability. As banks, funds, and financial service providers adopt blockchain-based systems, they need assets that can operate reliably at scale. XRP's market impact here is its positioning as a bridge asset designed for fast, low-cost transfers across jurisdictions. If institutions continue building on blockchain rails, assets embedded into that infrastructure stands to gain structural demand, not emotional buying. So, how big is the institutional custody market and why does it matter for XRP? In a video referenced here by Square, Garlinghouse projected that the digital asset custody market could approach $10 trillion by 2030. This figure represents the total value of digital assets that institutions will need to store, secure, and manage. Custody is not optional. It's a prerequisite for institutional participation. Market impact comes from the fact that custody services don't exist in isolation. They require liquidity, settlement, and transfer mechanisms. XRP enters this picture as a tool that can support efficient value movement between custodians, exchanges, and tokenized platforms. As custody grows, so does the need for assets that can move value instantly and compliantly. So why are payments, settlements, and tokenization all parts of the same puzzle? Garlinghouse emphasized that custody is only one piece of a much larger system. Institutions also require on-ramps, off-ramps, settlement layers, and tokenized asset support. These components must work together seamlessly. From a market perspective, this integration is where XRP's potential becomes clearer. XRP isn't positioned as a standalone speculative asset, it's designed to function within interconnected financial workflows. If tokenized stocks, bonds, and real world assets become mainstream, the need for fast and neutral settlement assets increases. This expands XRP's relevance beyond payments and into capital market infrastructure, dramatically widening its addressable market. So, how do existing bank relationships strengthen XRP's long term case? Squire highlights an important detail. Garlinghouse referenced early discussions with major global banks that were already using Ripple's technology. Even before Ripple expanded into custody services, banks were asking whether Ripple could start those needs. This matters because it shows organic demand, not forced adoption. Market impact comes from continuity. Ripple isn't trying to convince new players from scratch. It's deepening relationship. It's deepening relationships that already exist. By offering custody, payments, settlements, and tokenization as a unified package, Ripple strengthens its value proposition. XRP benefits indirectly as the asset that supports liquidity and movement within this expanding ecosystem. So why is utility more important than speculation and XRP's valuation? One of Squire's strongest points is that Garlinghouse $1 trillion reference is not about price hype. It's about functional demand. Assets that become embedded in daily financial operations gain value differently from speculative tokens. Market impact here is psychological as much as financial. Investors may begin evaluating XRP like infrastructure, not a meme asset. As institutions adopt blockchain-based workflows, assets that support those workflows can experience sustained demand. This kind of demand is less volatile and more resilient, which is exactly what long-term capital looks for. So, could infrastructure adoption make this timeline shorter than expected? Square concludes that if these infrastructure components continue aligning, custody growth, institutional adoption, and integrated financial tools, the path toward $1 trillion valuation may be closer than many expect. Not because of market euphoria, but because of necessity. Institutions move slowly, but once systems are in place, adoption can accelerate quickly. The market impact is a potential re-rating of XRP's role in global finance. Instead of waiting for sentiment-driven cycles, XRP's valuation could rise alongside real-world usage and demand. And finally, my own personal opinion to this is that this discussion is valuable because it shifts the XRP narrative into a mature institutional framework. A $100 XRP is not guaranteed, and it's certainly not imminent. However, the logic behind the scenario is structurally sound. If digital asset infrastructure reaches the scale projected, assets that are deeply integrated into the system will naturally command higher valuations. XRP's biggest strength is not hype, it's positioning. If Ripple continues executing on its institutional strategy, XRP's long-term valuation potential should not be dismissed lightly. And this finally ends our video. Thank you very much for watching and see you on the next one.